It's a pleasure and honor to introduce you to our friends and partners today. In the first place, let me introduce you to Deepak Kamra, one of our oldest partners. Deepak Kamra is working with Canaan Partners since 1991, having a long experience with the firm, focused on digital media and software. Currently sitting on boards of Harat Matrimony, E4E, Groundwork, Zeusk, one of our co-investments, Zubrance, etc. And historically also invested both in DoubleClick, Match.com, SuccessFactor, etc. Further, let me introduce you to Joe Diego from Also Pluie. To my right, Also Pluie is a firm investing in early stage startups and invested in Gowalla, Justin TV, Resilient, Ribbit, etc. Prior to Also Pluie, Joe has been working with In-Q-Tel, which is a strategic venture arm of US intelligence community, and with In-Q-Tel been working with and invested in Pixim, ThinkCom, Language Weaver, etc. Please meet Chris Rust, to my far right, from USVP, US Venture Partners. Chris Rust is focused on enterprise and data center infrastructure, cloud and mobile, just as consumer sectors. Currently sitting on boards of Across Silicon, Clustrix, GoPro, Cayman, and Zerto. He has been also working with a number of investments in Israel and India, and from 2001 to 2004, been CEO of Mahi Networks. Prior to that, he has been partnered with Sequoia Capital. And finally, please meet Wispy Dever, second to the right, from Sierra Ventures, focusing on consumer, social and mobile, enterprise and SaaS platforms, currently sitting on the boards of Payment, Revionics, etc. Previously has been active with corporate development group at McAfee, working on acquisitions, and currently with Sierra Ventures. Thank you very much for participating today. We're going to try to speak on behalf of startups today and try to have a little bit different panel from the ones that we had before. I was wondering whether we could discuss about the following. If you could put yourself in the shoes of startups and speak on their behalf, I was wondering why do you think that startups should choose to grow together with the VC firms instead of organically at all? We are meeting and we are working with a number of startups that have occasionally completely opposite opinions, and some of them I can say, and unfortunately, are they find the investments, especially the first rounds, as their highest objective, and quite often after the first rounds forget about what exactly the startups are for and what the business is for. Just as the other startups are completely in favor of not raising capital, doing it on their own, being bootstrapped. What is your opinion about it, and why do you think that venture community can help with the growth of the startups at all? Maybe we can start with Chris.
Sure. Thank you, Zarko. Can everybody hear me okay? I'm somewhat blinded by the light, so you'll have to forgive me. I think this is actually a very important question, one I've given quite a bit of thought to in the past. And some of you here may know a very successful entrepreneur, a serial entrepreneur in the Valley named Milton Chang, who founded Newport and a number of other companies that have gone on to great success. He's kind of a coach and mentor of mine, and he shared some great thoughts along the way. I think that it comes down to, in looking at organic company building versus venture funding, you really have to go back to first principles and think about how big is the market opportunity that you're addressing. What is the scope of work needed to address that market opportunity, and what kind of team do you have to pull together? And probably most importantly, how much time do you have to do so? If you're building a company on your own volition without outside funds, the programs tend to be a bit smaller in scope. They tend to be ones where you can begin to conduct commerce very quickly and become self-sustaining and independent, and then be able to grow the skills organically over time. If you go the venture funding route, quite often, the market opportunities that you pursue are larger, have more competition, have more time pressure to get your product to market, but are potentially a much larger reward quicker, right? So that's the trade-off. You give up some control, you broaden the scope of folks you need to interact with, but you hopefully plug yourself into a relationship ecosystem to give you access to talent for team building and help for getting lighthouse customers and so forth. So it's time to market and scope of opportunity.
Sounds good.
Okay, I'll jump in. This is a discussion we have a lot, especially in the consumer internet space, where the option is raise a little angel money, go to a certain point and sell the company fairly quickly in its life cycle. 10 million, 20 million. That's a lot of money if you own most of the company. It's a lot of money regardless. And we've had this discussion actually with a company that we invest in out of Plug and Play called Zoosk. And it was a social dating network. So they had a way to monetize. They had some traction. And the question was, do we really want to grow big? Is it a big enough market? If it is, do we really want to grow fast, or do we want to grow slowly and sell out fairly quickly? Or do we want to build a long-lasting, meaningful, large company that can make an impact as opposed to be part of something else pretty quickly? So it's what Chris is talking about, market size, how fast do you want to grow? There have been very few meaningful companies built without outside capital. Doesn't mean you have to take venture capital, but you will need outside capital if you want to build a meaningful company. I can't think of too many out there right now. So it's a question of what you want.
So I'll answer the different case study again. The market size is one way to answer it, but what's the pent-up market demand for your product, and how many competitors are there going after it? So one sector that we've all sort of lived through over the last couple of years is cloud storage. Pent-up market demand is phenomenal, both at the enterprise and at the consumer level. We're storing more files, we want them in the cloud, MP3s, video, et cetera. So a range of companies have come up. Box.net, Dropbox, Carbonite, and maybe a dozen others. If you look at the average amount of capital raised there, it's pretty significant, even at the earlier stages. Now, the better companies have raised less. But if you had a value proposition or a company in that sector and you tried to bootstrap your way there, there's probably no way for you to succeed. So that's an extreme example. There's pent-up market demand. It's unprofitable to target that market demand initially, but you make that decision to sacrifice profitability for growth, opening up.
I don't think I can add anything in terms of when you would do it. I think the issue is if there is a market that's expanding and you need to expand quickly, you're going to need capital in order to grow there. The question is, when you do take that money, are you going to be in alignment with the people that you take the money with? That's your focus. You have to remember that as soon as you take venture money, you're going to be driven to achieve those metrics quickly, and you've got to feel comfortable about having that focus, because that's what's going to happen. And if you think that you're going to be able to run the company, as a sole proprietorship, that's not going to happen. You can't do that. You can't make that expectation and take money from a venture capitalist. And if you do, you're just creating problems for yourself. And so, be honest. But it's for those of you that have solid relationships with other people, you'll know that another person adds, and good people multiply the relationship that you have. So I'm married, I have 2 kids, we've multiplied our relationship. Okay? That's one way to think about it. Now, we've only have 2, but I've tried for more. But the real issue is with taking money for a venture capitalist, that's the way you've got to be thinking about it. You can either take a big piece of a small pie, or you can take a slightly smaller piece of a much larger pie. And that's the focus. That's what you've got to be, that's got to be your vision. And the venture capitalist is going to be assessing your willingness to do that as well.
Thank you so much for this. And provided the startup decides to take money from the VCs, and let's say provided it has offer from a number of tier 1 VCs, what should startups look for when choosing whose money to take on? What exactly is making a good match between the startup and the VC? And then finally, are there differences between among the partners within the partnerships that startups should actually try to look to connect with one or the other when looking at connecting with a particular firm?
So I think you should look for gray hair. and it doesn't have to be a lot of gray hair. So yeah, I think it's very important. I mean, you're just wasting your time and the VC firms if you don't do your research first and figure out who it is that does investments in your market at your stage in particular, has the connections for business development for you, whatever it is you're starting. You know, it's very specific, even within a narrow area, or within one area like consumer internet. It's obvious you're not going to go to a healthcare firm, but even within that, you know, is it about payments? Do you need to know the telcos? Do you need to know somebody at Facebook? So those sort of connections are important. But within that, within a venture firm, once you found them, I'll let somebody else answer as to who the right person is to go to.
Yeah, so divide by sector, stage, geography. So that's a high-level sort of clarification or qualifying parameter there. And then look within your sector as well where the experts are. So I'll give you examples for Sierra where we are. So we had a great success in online travel in a company in India called Make My Trip. And by default, online travel in emerging markets is a very high growth area right now. And by default, the smart entrepreneurs who are doing online travel or anything related worldwide sort of come to us to filter it. Now, we are experts there. We are able to quickly make a decision and then add value if we do invest. A second thing we have at Sierra is, and this is again doing homework, we have a CIO advisory board that consists of 75 global 2000 CIOs. These are guys with $30 billion in IT budget. Now the reason we have this is because more than half our companies sell to CIOs. So if you're a startup entrepreneur and you're selling IT software to CIOs, we're a great target for that. So I would say do your homework around sectors, companies the firm is invested in, but also what the peripheral network looks like.
I think those are all excellent comments. A couple of things that I would add. You know, effective company building is people working with people, and so the culture fit and the chemistry fit between the firm and your company, and more importantly, between the individual that would join your board of directors, and that you would work with both inside the confines of the board and hopefully quite actively outside of the board. It's really important. Really, really important. And that requires spending face time with each other. Just like if you were evaluating adding an executive to your management team, it should be a two-way evaluation. Due diligence is not a one-way thing. Assessing that chemistry fit is really, really critical.
And back to my earlier analogy, you're going to be stuck with that person for 7 to 10 years. It's quite likely. It is like a marriage. So just as Chris was saying, you need to spend some time you know, with them and making sure that there's a good fit. Is one thing that hasn't come up, and I think you know, the responses that you've gotten have all been very good in terms of the positive, and I'll give you a negative that you want to watch out for, is you want to be careful of how much board drag you're going to get. Right. You know, how many assignments that you're going to get to do for purely doing the assignments. So I'm an ex-operating guy myself. I've grown companies myself. And in fact, all the people at Alsop Louis have all been operators. We've all grown companies. I've done 2 IPOs. Bill Coleman did one of the fastest, you know, BEA Systems, one of the fastest companies to get to $1 billion. Gilman Louis was in the games business. Stuart Alsop has done a lot of media companies. And Jim Wims has done you know, things for large enterprises such as you know, fastest to $500 million with Sony PlayStation. So we're all people that want to basically help you build that company. But we're also operators that understand that we're not going to give you assignments just to do assignments. You know, that's and you get a lot of that in the boardroom, and you got to be really careful. As has been said previously, you want partners that are going to add value, and we expect that people evaluate us just as we evaluate them. So that's an expectation that we have.
I'll add one more. Go ahead.
Along those same lines, you know, having worked with, been on over 30 privately held company boards. I found that the success rate of the companies is actually inversely proportional to the thickness of the board packages, right? And if you're spending a lot of time building very elaborate reporting to manage that relationship in an upward direction, you're not spending the time that or you're spending time that could be spent delighting customers and building best-in-class product and building out your management team. So finding a relationship and building a strong board, which really does understand and values economy of movement, is really, really important. In some ways, I actually think that selecting your investors is more important than selecting your spouse, because you can divorce your spouse, but you're stuck with your investors.
Very good.
Thank you so much, Vice.
Yeah, related slightly, I usually give this controversial feedback to entrepreneurs, which is, go find the VCs that qualify based on all the parameters we just described, but go out to 4 or 5, and then elicit some very candid feedback from them as to why they're not participating if they aren't, rather than, which is what a lot of entrepreneurs do, is just knock on VC door after another, and finally they're at number 20, and it's just too many. There's something inherently wrong, and you should take that back. It's controversial because often door number 21 could be the one writing the check, but I still advise against it because those first 4 or 5 are best qualified to serve you as investor.
Thank you so much. I would like to tackle an issue of your decision-making process, and against the general notion, it's very much structured process that not many people are actually aware of. What exactly is happening within the VC firms? How do you make decisions about it? What is happening on partnership meetings? How do you allocate resources of your partners in respect of different roles that partners would have within the decision-making process, from due diligence, or so actually from sourcing the startups over due diligence and advising the startups after the investment?
So, anybody have one of those 8 balls? Sometimes that's what it feels like, right? Sometimes you walk in, you think you've got a good pitch. So every VC firm is going to have their specialties. So if you walk into a firm and you're not in that specialty, right now for us, very similar to the IBM slides where they talked about the Internet of Things and the smart planet, that's our focus is, we've called it the Evernet, and we want to invest there for our next round for this particular fund. If you walk in outside of that, significantly outside of that, it's going to be hard to get a meeting. When you're in the meeting, we're not going to be as engaged, et cetera. So to the extent that you're focused in the area of sweet spot for that firm, that's going to make a big difference. Within that, people are going to have, each of the different partners are going to have a different area of expertise. Those partners will know more or less about that particular arena. Our firm, because we are so early stage, there's not going to be a tremendous amount of evidence that you're going to be able to give us for validation. That's just the way it is. We have to make bets on disruptive companies before those bets are seen and understood. And so, we have to do a lot by gut feel. We'll do a lot by gut feel for the marketplace, but what we won't really do a lot by gut feel is the technology. So we want to make sure that you understand your technology inside and out. You have to prove that this company can actually be a company that's worth venture funding, and you can leave it for us that their marketplace will exist. That's going to vary depending upon the stage that you're in. That's, again, at early stages, that's what we want. We want something that's going to be disruptive where the market doesn't exist today. In a later stage, you're going to have to prove out what you have. And we're going to help you do that when we go and get that Series B.
So you mean decision-making process internally at the firm? So there's 10 of us at the firm, divided up by sector focus. Software is one bucket, and then non-software separately. And our process is 2 of us will engage with a company prior to bringing the company in for a full partner meeting. Full partner meeting any day of the week is when all 10 of us are there. The 2 that have been engaged with the company have probably spent anywhere from 1 to 2 meetings with the company, but probably about 10 to 12 hours doing their own homework on the sector and the space. The two of us will present internally, then the company will come in and we'll make a decision immediately after. So we'll promise to get to that within anywhere from 7 to 10 days after meeting a company initially. And once that partner meeting is done, it's a decision whether to move forward or not. If not, then we'll give very concrete reasons as to why not. And if yes, then it's a separate path that includes maybe additional diligence, but also obviously a negotiation.
Very similar. In our case, any 2 negative votes, after the final presentation to the partner meeting, any 2 negative votes can kill an investment. So we have to make sure that pretty much everybody is on board. You can have a couple of dissenting voices out of 9, basically, but that's about it. And I would just point out that from a startup's point of view, it looks sort of opaque on the outside, and you don't understand why some people are excited, some people are not. I mean, I think the thing to remember is that individual venture capitalists don't do hundreds of deals a year. They're not angel investors. Sometimes they're seed investors, but it still doesn't mean they're going to do, in most cases, a principal at a venture firm will do 1, 2, at the most 3 investments a year. So if you happen to catch him at the wrong time on the wrong day and it's not his exact space, or he's just made a couple of investments, it's not your fault. It's could be something else totally internal to the firm.
Yeah, one piece of advice that I always offer to entrepreneurs that are seeking financing is treat it like a sales campaign. It's amazing how many companies are extremely disciplined in how they approach customers, in qualifying the customer, understanding the decision-making chain, understanding the customer's needs, working on the product market fit, and then they spend far less time trying to understand their target audience when they're going to ask that audience for significant amounts of money. By doing a little bit of work on a firm before you approach that firm, and really trying to understand who the people are, what their backgrounds are, what their track records are, and so forth, helps you to find the right person. And every single day, I get around 200 emails a day, 7 days a week. When folks approach me seeking funding, the path with which they contact me is actually pretty important. And so in terms of process, by beginning to try and beginning the process by understanding what your target cares about, it helps you to shape how you approach and so forth. High growth potential markets, compelling vision, people that really have spent the time and energy to understand product market fit and have a good grasp of what the needs are. And then at the end of the day, serious folks that are very, very committed to success. These are kind of key check marks. Now, all investment diligence in early stage, which is where I focus as well, is flawed because you're fundamentally making highly subjective decisions with incomplete data, almost by definition. It's that Gretzky adage of go where the puck is, not where it's been. You just make the best with the information that you can gather, and hopefully, you get it right enough times that you deliver good returns.
Thanks so much. I think that we can afford a couple of more minutes. Having interest of our audience in mind, and we probably have around about 20% of international startups in the audience, and all of you have had international experience in your work. I would like to address an issue of international startup pitching in Silicon Valley, trying to move to Silicon Valley, grow in Silicon Valley, or stay in their respective countries and get investments from your firms there too. Today, does it make sense at all for startups to pitch in Silicon Valley before they move here?
Absolutely.
If they have, if they have to move here, yes, they should be pitching here. But I mean, for instance, we have an India office, and the market for most of the companies we see in India is India. There's no real reason for them to raise money here. The expertise they need is in India, and I think for them, Silicon Valley can be a distraction. On the other hand, our Israeli companies, the market for them is here. And while the technology and the knowledge resides in Israel, they're going to have to open something here. They're going to have a major presence here. So I think it makes sense, maybe not for their first round, but for their second round to be in Silicon Valley. So it really depends, I think, is where you're going to be focused and where you're going to do most of your transactions, your business development, Where's your market?
I'll answer just for India because I spend about 15% of my time on our India investments. And it's been, India is where on the internet side and on enterprise IT side is where the US was 10 to 12 years ago even. And just starting to get to hundreds of millions of users who are online, and hence all the applications both on the consumer and the enterprise side now become applicable. So it's been mostly around markets for India itself. And online travel, personals, jobs, et cetera, have all been sort of great sectors there. Just now in the last year, thanks to both Open Mobile and Open Social, we're looking at Indian entrepreneurs who are building products for global markets. So last year, the first time over the summer, I had interaction with at least half a dozen Indian entrepreneurs who were building something for the US market and were applying to the likes of Plug and Play and Y Combinator and the rest. Now, the unfortunate thing was that for a few reasons, the incubators, I'm not sure if PNP is in this category, but some of the others weren't receptive. And one of the reasons was a goal for them would be that the entrepreneurs stayed here and didn't go back, and you just couldn't guarantee that. And then secondly, just from an immigration standpoint, it became difficult. So from all those 6 that I was working with informally, none of them got accepted anywhere and they went back. So I think that's opportunity.
Thank you. And Joe, you still work for Austrian startup. Share this experience with us.
Yeah, I think by being here, everybody sees the unique culture that we have here in the Silicon Valley. The issue is your company ready for this, and is it focused on a global basis? So we had I actually ran an Austrian company for a while, went back and I ran it here. That company was successful early in Europe. So it developed a leadership position in Europe and then decided to expand to the US. So there's no set rule for this. To the extent that you can do that, the venture community is starting actually to blossom in Europe right now, and you might be able to find the money there. But if you're going to start a global company, you can also, it's quite easily to bring all the folks here and start it here.
Thank you so much, all of you. We could have like a couple of more questions from the audience.
Anyway, this is to Mr. Alsop, but anybody on the panel.
Actually, it's a Diego. Somehow there's so there is a Joe Alsop at Alsop Louis, but I'm Joe Diego.
Oh, sorry. Okay.
That's okay.
Pictures look alike. Okay, Mr. Diego, I just wanted to, but anyone on the panel, just extend something you had said. Some of the startups that are in pre-traction mode, I think that's the term they choose now. In other words, they've got a great idea. It's confirmed it's a good idea. It's a very detailed deployment plan. But it's sort of the chicken-egg problem, that $200,000 that would prove the viable model isn't available. That's why they're out pitching. I've heard that there's some, for lack of a better word, called discovery funds, or there's some kind of a mechanism for working when you're pre-traction. And from what you said, you seem to imply that your firm is in that area? Or?
Well, let me say that what I was trying to express was that in early stage investing, there often isn't an established market. So we are oftentimes looking at a market that for a set of products that doesn't exist yet. Exactly. And so we take that on as part of the process. But you as an entrepreneur have to have thought about where that market could be and should be, and have the technology that will create that market. So anybody can come up with a spreadsheet that shows you're going to be in a $100 million market at some time. And if that market doesn't exist, we've got to be able to assess through a whole set of metrics. So I'll give you an example. In terms of, if you're going to be doing an engineering product, a product for a particular set of engineers, one of the first things that we'd want to know is, okay, how many of those engineers are there in the United States? What tools are they using right now instead? Of those tools, of those tool vendors, what are they going to do in the future with when they see that you have brought out a tool, and do they own the customers such that your tool is going to be insignificant? So what I'm giving you, now you could have put together a market plan that said you're going to be $100 million, but there are many ways to evaluate that, and that's what I was trying to express. That market doesn't exist today. If you go to Gardner, nobody's going to say, hey, there's a $100 million market here. And so in early stage, we want to make sure that there's a market, but we're not going to know that there is.
Thank you so much. We can take one more short question.
Well, I'm French. I will try to be short. It's hard. So I came 4 years ago. I work for a PR company based in Paris. So we do PR in Europe, whatever. When I came 4 years ago, it was very easy to explain to a French entrepreneur coming, well, guys, you have to rise like about, you can rise $5 million. You have to prove that you can make like $50 million in the coming 3 to 5 years. It was very easy to understand and to explain what are the rules. 4 years after I spent in Silicon Valley, I'm really wondering what are the metrics right now, because I don't really get, I think it's like very strange. Can you summarize which numbers, just a short answer, which numbers would be like the ideal, rising thing which is in Silicon Valley now?
No.
Okay.
The rules keep changing on us also. I mean, it's not like the rules have been stable for the last 20 years. So if you want to raise 5 million, what's the right number? I don't know. Does it have to be revenue? In some cases, no. Does it have to be number of users? There's so many different milestones that you could point to that it's really difficult to say, here's what you need. Anybody else want to try that?
Yeah, I'll try it. So without getting to absolute numbers, if you just think that you're going to give up 20 to 25% of the company in every round, regardless what the size is, what does the exit need to be such that everyone, including the founders, the common shareholders, and the investors, are going to get the return that they want to see? So the more you raise every one of those rounds, that exit value, or potential exit value, has to go up, and you have to be able to envision that.
I'm just going to give you a thought. Instagram, 9 people, $500 million valuation. Today, right? That's still happening today. So you can do that. You've just got to have a great enough idea.
Yeah, let me just point out, though, that's not a rule, that's an exception.
That's the exception.
Because there are at least 10 well-funded photo sharing, or I don't even know if you can put Instagram in that category, that have been funded and have significant user traction, but have gone away or have no business model. Instagram has somehow leaped above that. And it's a mystery to some, but it's not. I don't think that's a rule you can live by.
It's not a rule. And it's an aspiration.
Yes, exactly.
Sounds good. Thank you so much for spending some time with us.